Hi, everyone. This is Jason Bierk of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. I consider him a good friend in the oil and natural gas industry now that I've been getting to know him for years. I like to have him on every couple months. We've had the oil price have a correction in the last, 6 weeks or so. A lot of hedge funds are back shorting, a lot of oil bears out there shorting oil, telling me it's going way below 65 again. As it was similar case 6 to 8 months ago, similar to West Texas Intermediate. We're at the West Texas Intermediate crude oil price at $77.10. Brent crude's at $81.67. We're recording this interview on Wednesday, November 22nd, 2023. Happy Thanksgiving to our American listeners out there. Thank you for coming back on, President of the Energy Prospectus Group and former Senior Executive at Hess Oil, Dan Steffens.
Yeah, thanks. I'm glad to be on here. I tell you, it's been a crazy year. I'm looking at a 1-year chart for oil, and it's just zigzag, zigzag. I mean, I think the paper traders, day traders, love these patterns. But if you take a 1-year oil price chart, right now we're closed on Wednesday today. We're closed right around just below $77. That would be right through the middle of the chart. But we've had lows down to 67 and high just a few months, 2 months ago of 92, when stuff in Israel all started. But anyway, it's been a crazy year, I'll tell you.
Yeah, that's a good point. It's been a trading range. I mean, the sentiment though to start the year. So oil got November 2022 highs. We had the rig count here in the United States got to a very high level. And since about a year ago, November 2022, the rig count's down over 20% now.
Yeah, I mean, if you just look at the fundamentals, the supply and demand is really tight globally. But you got all these, geopolitical things. We had the war. We got Russia, which is one of the top 3 oil producers in the world. We're basically in a war with them. We're funding a war against them in Ukraine. So that's a big deal. And then you got this stuff going on in the Middle East with Israel and Hamas that I just saw today. We're bombing, these militant groups funded by Iran over there. So basically, we're kind of in a shooting war with Iran's, hired guns over there. So, if you just said that and you didn't look at anything else, you would think, man, oil's got to be triple digits or something with all this geopolitical stuff going, especially in the Middle East. I don't know, but it's
that's not what the hedge funds and the oil bears that are trolling me on Twitter and in the comment section of these YouTube videos are saying. They're saying recession or depression. They're saying the U.S. oil inventory levels are at record highs. I hear that a lot. And then I'm also hearing that the EIA data, so that's the U.S. Department of Energy, the EIA comes out with this number. And it's saying that U.S. oil production is at all-time record highs, but that number is very misleading, isn't it? It's not all oil in that number.
Well, that's true, but I mean, but the global demand for oil-based products is going up more than 2.2 or 2.3 million barrels per day this year. We're not adding that much supply. We are at record, but it's taken us this long to get back to pre-pandemic levels. So it's taken almost 3 years to get back to where we were before the pandemic. And really, the only oil basin in the country that's got any upside is the Permian Basin. All the other major oil basins, the Bakken, the DJ Basin, even Oklahoma, and that they're pretty much they've peaked. They're rolling over, and there's some predictions that sometime next year the Permian Basin might peak out, and that'll be it. And without that, we got nothing. Unless suddenly you'd get the Biden administration open up the Gulf of Mexico and start allowing more drilling out. But I don't see that happening, not while they're still in office.
Well, also the federal lands too in the Permian, right? Those are blocked too, so they didn't permit those as well.
Yeah, right. But I mean, there's a lot of drilling locations still left, but and we're getting better results. They're completing longer laterals. They have targeted frac jobs. They have more technology they're applying to this. And even though the rig count's down, we're getting good production per well, especially really primarily just coming from the Permian Basin. All the growth is coming from the Permian Basin.
But is the tier 1 acreage, so the best acreage in the Permian Basin, is that running low now?
Yeah, they're using some of that up, but There's still a lot left in the Delaware Basin, which is the western half of the Permian. Some of the best wells I've ever seen are being drilled in southeastern New Mexico, out there in the Delaware Basin. There's some, there still need to be more infrastructure out there. They need more pipeline connectivity and stuff like that. But that's where it's coming from. And there's upside in Oklahoma. There's upside in the DJ Basin, and a little bit, but there just isn't that much drilling activity in those other places right now.
So the upside you're talking about in the best wells, is that where ExxonMobil just made the acquisition for Pioneer Natural Resources? So they're targeting that area?
Yeah. And the reason they did that, I mean, all the good stuff's already leased up. So the only way an Exxon's going to get, a big increase is to go buy a company that already holds it. And they bought the best one. I mean, Pioneer, which they're paying about $60 billion for it, which I thought was a pretty good price for that. But they are getting a whole bunch of thousands of high quality drilling locations. And Exxon has already publicly said that they believe that they can, re-enter some of these older areas and recomplete wells and stuff like that to increase production. Because, we didn't have all these targeted fracs. So you can go into some of those areas where they drilled horizontal wells 3 or 4 years ago and, re-drill wells or recomplete those wells with better frac jobs, and I think they can keep it going. So I think our production now is just over about 13 million barrels per day. Maybe we can get to 14 million. It's going to be a stretch. And then after that, I think it's just going to plateau unless, we open up a bunch of federal lands, open up the Gulf of Mexico. I don't see any way you get past that.
Well, that number also includes a lot of natural gas liquids, a lot of condensates. It's not all pure oil. So it's misleading. If you talk to either oil experts like you or petroleum engineers or petroleum geologists, they'll talk about how at least 30% of these Permian Basin wells are not pure oil. So there's a lot of natural gas liquids inside these wells in each barrel they pull out.
Yeah. And what your listeners need to remember is all oil is not the same. You need black oil to produce diesel and home heating oil to produce distillates. The oil we're getting on a lot of these shale plays is ultra light oil, and it's very good for gasoline. In fact, coming out of the ground, it looks like gasoline. It's pretty much clean. You don't want to put it directly into your car, but you can't make some products out of it because you don't have a long enough hydrocarbon molecule. So what we're doing, we have to import heavy oil, even from Venezuela and people like that, and we are exporting about 5 or 6 million barrels a day of this ultra light oil to the refineries, primarily Europe, that were built to handle lighter oils.
Okay, that makes a lot of sense. So the refining capacity globally is not at the levels of the U.S. So a lot of the oil, the heavy sour crude is still coming here to the U.S. So you were talking about like the black oil. That's the heavy sour crude. Now that's better you can make a lot of different products with the heavy sour compared to the light sweet crude.
Yeah, well, and I don't mean really heavy oil. I mean, it can't be this ultra light stuff. I mean, you can still have 30 gravity, but some of this stuff is like 40 gravity oil. I mean, it literally in a jar looks like water. It's clear. It's that good. And you can make gasoline out of it, but you can't make the other stuff out of it. And a lot of products need heavy oil. I call it black oil, but all oil is not the same. So you need the right kind. And some of these refineries we have a lot of refineries that we made to get Canadian oil from the oil sands and from Venezuela. We're made to handle that heavy oil. And, we need a lot of it. And this country runs on oil. Our distillate inventory today, EIA announced, is 13% below the 5-year average. I mean, this country runs on diesel, home heating oil. We need that. But all trucks, heavy equipment, everything, it runs on diesel. You cannot run those things on gasoline. So we need that heavy oil.
And you were talking before we started recording that surprisingly, and the oil bears are not admitting this, that the 5-year average for a lot of the inventories here in the U.S. are below the averages, correct?
Well, and I think they're also want to talk down the price of oil because, they don't want gasoline to go through the roof. That it's contributing to inflation, and they're biggest Christmas present will come if the Fed says, okay, we're going to stop raising interest rates. So the last thing they want to see is drive by filling stations and see $5, $6, $7 gasoline because they know, and then, transportation fuels go into the price of everything. So that's why your grocery store prices are so high because of that. Anyway, but eventually supply and demand fundamentals come into play. And we're still increasing. And then we're also this time of the year, once you get past Labor Day, once you get into mid-September through October, that's some of the lowest demand period of the year for oil-based products. Well, now, once you get and the winter starts arriving, you get heating oil demand up there and you get more people traveling for the holidays. So transportation fuel demand goes up. So we'll pick up. Now, after you get past the holidays, then it dips a little bit in the first quarter before it ramps up. But I think when we get to, May, June of next year and demand really ramps up during that period, especially after the kids get out of school. And we're going to need every barrel of oil of OPEC oil at that time. So,
and OPEC, they're below their production quotas, and OPEC's even talking recently in the last week. The Saudis and OPEC Plus are talking about another million barrel per day production cut, and they're already maintaining the current production cuts. Russia and the Saudis are.
Yeah, I think that was priced in a market for the last couple of days, and then on Wednesday morning, it came out that Saudi Arabia had postponed their meeting. They were supposed to meet, I believe, on the 26th, and then they pushed that back to the 30th because they need to convince more of the OPEC members to help them with the cuts, because they've been carrying the brunt of these production cuts. But put in your shoes, if you have your country, that country relies almost totally on oil revenues. Well, they don't want to sell their oil for $50 or $60 a barrel. They want to sell for 80, 90 or $100 a barrel. I mean, even they know it's going to run out eventually. And so they don't want to give it away. And they're totally in control. They and Russia are totally in control of the global oil market because we're a net importer. I mean, that's just the fact. We're a net importer of oil cannot control the price. So that's where we sit right now.
Also, I would argue that at the current West Texas Intermediate price, also the other factor is cost of capital with the interest rates, because there's a lot of accredited investors, institutional investors that are saying, why should I go fund a private shale driller when I can quote unquote risk-free at around 5% for a money market fund or short-term treasury. So that's taking a lot of capital out of the sector. And I would argue that that's going to restrict a lot of potential new oil supply.
Yeah. One thing I think you just hit the nail on the head there is some of these drilling funds, some of these private drilling funds, because we still have a lot of wells in the United States that are drilled by private companies that raise a lot of money each year for these drilling programs. And they're going to have a tougher time with higher interest because, like you said, I can go risk free and get 5-6%. Why do I want to invest in this? A lot of them invested for the tax write offs and stuff like that. But and those private guys do not have access to the really high quality acreage out there. Most of the really good tier one acreage is owned by some of the bigger companies like EOG, Diamondback, Pioneer. In there obviously held a lot of it. So anyway, there's not a lot of open acreage, really good acreage that's left to lease. So,
well, haven't EOG and Sandridge and Pioneer, haven't they been very aggressive the last 6 to 8 months with the interest rates? They've been going and buying up a lot of those shale drillers that were private, like you said, because those guys have just decided we can't raise capital anymore. We don't want to drill with interest rates where they are. So we're just going to sell to the bigger guys that have cheaper cost of capital. And I think I would argue you're seeing that also with like ExxonMobil and Chevron too.
Yeah, well, two companies that I like finally merged. Earthstone merged into Permian Resources. Permian Resources was created by a private company called Colgate, merged with a public company and changed their name to Permian Resources. And then Earthstone was backed by NCAP and some other big deep pocket investors, and they were buying up private companies right and left. and they built up to over 100,000 barrels a day of production. Well, they merged into Permian Resources. So at post-merger, that company has 300,000 barrels a day of production, which is about half of what Pioneer had. And yet its market cap is only a quarter of, in fact, it's less. It's not, so Pioneer sold to Exxon for $60 billion. Well, go look at Permian Resources, that symbol is PR, and it has a total market cap of under $10 billion. So it's selling at a deep discount to what they hold a lot of really high quality acreage in the Delaware Basin. So I consider that right now. People ask me, what's your next big takeover target? It would be Permian Resources at the top of that list.
Which size company would be interested in that, like an EOG or Sandridge or one of those guys? Because if they're only 10 billion, it doesn't seem like ExxonMobil would be interested.
No, I don't think ExxonMobil would be, but actually on their conference call the other day, Diamondback said they're people were asking them about M&A activity, and they say we'd be a buyer. We're not interested in selling this company, but we would be interested in the right deal if it came along. If you merged Permian Resources into Diamondback, you'd have a company that was every bit as good as Pioneer, every bit. I mean, because Diamondback is first class, and Permian Resources has a lot of high quality Delaware Basin acreage.
Also, there's rumors for the natural gas side that Chesapeake Energy may rebuy the assets with Southwestern, so that could be the next potential big deal.
Yeah. On that side, I don't follow either one of those companies right now, but I have followed Southwestern in the past, so that would make some sense. I mean, it's going to be a while before we see high gas prices, but still, I mean, gas today is, just under $3, and they're still very profitable. The gas companies are still very profitable at $3 gas, and we've averaged this quarter probably about 320, 325. I'm using $3 in my forecast models, but the middle of next year, we'll start seeing much, much higher gas prices because we have two big LNG export facilities coming online the middle of next year, and then after that, it's just one right after the other, and we're going to ramp up our LNG export capacity in the U.S.
Yeah, now that Freeport, the liquefied natural gas, is back online, I think the U.S. just hit a couple days ago a record amount of liquefied natural gas exports.
Yeah, I think we're over 14 BCF per day. That's about 15% of our total supply. And by the end of 2027, if you include the pipeline exports going to Mexico, our total export capacity could be as high as 40 BCF per day. And when we get there, you're going to see the international gas prices, which are much, much higher than what we pay, impacting our price. And Raymond James' official forecast is that after 2024, they're expecting the gas price to average over $5. If I put $5 gas in a lot of these companies like a Chesapeake, Southwestern, or EQT, Range Resources, Antero, man, their numbers are fantastic. If you say they're going to get $5 for their gas, and they're good, they're profitable now. They're profitable at $2.75, $3 gas.
Yeah, a lot of them hedged at a higher price a while ago. I think we were talking about Jerry Jones's company too. That was a product of a couple of mergers in prior interviews. Yeah. But do you expect the oil production growth then to slow down with the interest rates where they are and the current oil prices? And so you think then that maybe ExxonMobil will slow down the production growth of the Permian wells that they just acquired?
No, I don't think they will do that. But okay. There's some seasonality to it because you have a lot less well complete. It's more expensive to try to deal with the winter weather. So usually production and a lot of companies want to complete a lot of wells into year end so they get credit for them in their year end reserve report. So you usually have a peaking in November, December of each year. Then it kind of drifts lower in the first quarter. I mean, demand for oil goes down a little bit too, but just because of weather related issues, it goes down. And then you get the problems up north in Canada and the Bakken where it's, with spring breakup and all that. So it really doesn't then start picking back up production growth until you get to May, June, July of each year. It's kind of just weather related.
Do you think it's also that the oil price of West Texas Intermediate is getting close to the production cost for oil? Because I remember around 65, when we were around 65, that a lot of these higher cost wells were starting to get uneconomic earlier this year, about 60 months ago.
I mean, the companies are still cash flow positive, even if oil went down to 30. Now, if you say all in, how are they going to pay out the wells? But, they're profitable at $60 oil. Definitely. I mean, because they're all in operating expenses, cash operating expenses for most of these companies is in the mid 20s. I mean, that's everything. That includes lease expenses, production taxes, back office cost, G&A, everything. All their cash costs are not over $30 a barrel. That's for sure.
So cost to drill. So with all the higher input costs, the higher interest rates, labor costs going up, you wouldn't say that the cost to drill wells is up a lot in the last couple of years?
No, actually, the completed well costs have come down because tubular prices have come down, and because you have the active rig count coming down. It's rig rates have come down a little bit. You have completion crew rates have come down a little bit. So compared to last year, we're down a little bit. So everything looks okay. Now, those are really expensive wells. And some of these, deep, 2-3 mile long laterals in these shale plays. Yeah, these are $8-10 million wells. So to pay out the well, then they need $60 oil maybe to pay out the well in a couple of years. But still, I'm seeing wells paying out in 18-20 months. What did I look at? I looked at Baytex the other day, a Canadian company. They have like 6 core areas, and in every core area, all their wells pay out in less than 20 months. When I was at Hess, we were happy as hell to get wells paying out in 3 years. I mean, they have some areas that all their wells are paying out in less than a year.
Well, actually, I was going to ask you about Hess, because it seems that Hess, with the big exploration discovery there on Deepwater Guyana, that Chevron's going to take them over.
Oh, yeah, they're going to be a takeover. John Hess wanted to be takeover, go out at the top. John's I went to work there in 1983, and John was, going around taking the tour of the different companies. His father wanted him to take over. Leon Hess was his father that founded the company. And so I met him back then when I first started with Hess. And then when Leon died, he took over. But he's about 70 or over now. I think he's a little bit older than I am. And he gets to be on the Chevron board. He's going to collect bigger dividend. I mean, they pay a better dividend than Hess paid. So he has more dividend income than he knows what to do with. And I think it's a good deal. I think it's a good deal for the Hess shareholders. So they'll probably all accept it and move on from there.
Well, Chevron also didn't have the best acreage there. So Hess did with the joint venture with ExxonMobil. So Chevron had to play catch up there to ExxonMobil, and the CapEx bills. That's an amazing growth play there for the deep water, but it's just very expensive with the upfront CapEx to develop the wells.
Oh, yeah. Yeah, that's big boy stuff, man. It's when you're in deep water offshore, you're years of money spending, but then when they come online, they pay out very quickly. It's a different ballgame. Those are not shale plays or anything. They're very productive wells with those pressures in the deep water.
And doesn't the Hess family, they own the New York Jets too, right?
No, that was sold.
Okay.
At
to
Leon's,
Johnson's. Oh yeah.
At Leon's death, it was in his will that they sell it. Believe it or not, that was a long time ago. I was still there when that happened.
Yeah, I just saw TV commercials that Hess is selling like those toy trucks, the green and white ones that are popular with kids.
Oh,
those are the same colors as the New York Football Jets.
Yeah, and if anybody wants it, I got a big shelf full of them that haven't even been opened if they want them.
Actually, those are probably worth a lot of money too.
They probably will be. They're all like 30 years old.
They're probably worth a lot of money to an antique collector, man. I'm sure you could probably sell them for a lot more than you think. I mean, if first edition Pokemon cards holograms are selling for hundreds or thousands of dollars, then those antiques are even more rare.
Yeah, one of my neighbors that worked for Texaco, he had all those Texaco toy trucks and everything. And I think he moved on, and they sold them for quite a bit, I think.
So in the short term, oil may be range bound. It may go a little bit lower due to the macro factors and the hedge funds and the bears that are shorting it. But it sounds like there's not going to be a lot of new supply coming online, not a high percentage of new supply coming online. Also sounds like OPEC could cut. And then the other side of this is that I don't hear the bears talk about this, global oil inventories. The global oil inventories are not at high levels.
No, they're not. No, they're not. Go read the IEA November oil market report, and you'll see that global oil inventories are way down. Above ground inventories are way down. We're going to need every barrel of OPEC production at some point. There's just no way that outside of OPEC, there's enough production upside. I mean, if we start having now IEA, which is the International Energy Agency based in Paris, and remember they're based in Paris where they wrote the Paris Climate Accord. These guys, their bosses want oil to go down. They want, less, oil in the world. That ain't happening. So they are always low on their demand forecast. I think demand is going to go up another 2.5 million barrels a day next year. And if that happens, we're going to need every ounce of OPEC production. That's just all there is to it. The real demand for oil is much, much higher than people realize. It's just that we ration it by price. Poor people in Africa can't afford $5 gasoline. So that's how it's rationed, but they would love to have it. They would love to have those cooking fuels and stuff instead of using, wood to cook their food over. So there's tremendous demand in the world for oil-based products.
Well, global oil demand actually, surprisingly for most people, hit a record amount earlier this year, about 6 months ago, according to a lot of research. So that surprised people because a lot of people are saying, well, China's not back online. China's not consuming the record amount of oil production growth that people expected. What they don't realize, I think, is that in a lot of these other emerging market countries, people are buying like their first small car, or they're on a scooter or a motorcycle. So they're actually consuming oil, gasoline and diesel in smaller increments, but there's a lot of new vehicles on the road that are not sport utility vehicles like here in the US, but there are a lot of new vehicles. Those people used to either walk or use a bicycle or take public transportation. Now they're consuming a lot of energy, gasoline and diesel through smaller vehicles.
Yeah, overall demand for energy in India is probably going up faster than it is in China. Their citizens are demanding better electricity grid. They're building coal-fired power plants like it's going out of style. I saw a chart the other day. Since the Paris Climate Accord was signed, of all the coal-fired power plants that have been retired in the U.S. and all of Europe, China and India have built more than that number. So all we've done is shifted the carbon emissions to the east. So we're lowering our carbon emissions here
voluntarily.
And that's why so they're going to have cheaper energy because they're willing to do coal-fired power plants. And we're shifting our energy security to the east. That's what's being transitioned, period.
Well, they need more cheap electricity and cheap energy in general. They're also building nuclear power plants. But their ESG spending has been, all these governments, their ESG spending has been a total joke. I think there's trillions of losses on ESG. We're finally starting to hear that wind, solar, biofuels, all these companies are either bankrupt, need bailouts in Germany for Siemens Wind and Solar, or the return on investment has been negative, despite the research reports coming out from like McKinsey and Booz Allen Hamilton and Accenture and the energy lobbyists, the ESG lobbyists harassing me in the comments section and in emails, writing 5-page reports telling me that wind and solar are economic.
Yeah. My personal rule is never invest in anything that needs government subsidies.
Well, if
it was good, it wouldn't need the government subsidies.
I agree. But if you're a DC insider here in the DC metro area and your friends and family members are on the board of directors of this company and you got the shares for a couple of pennies, you can do a pump and dump in like 2 years and cash out your shares from a couple of pennies to $5 and you're out before the company goes bankrupt.
Yeah. See, now you figured it out.
Well, I've lived in the DC metro area for 20 years, and most of the people here with the most expensive cars now are all connected to ESG.
Yeah, there you go. And they all drive big SUVs, probably.
Some of them do. Some of them have like $150,000 Ferraris, and I'm seeing like $150,000 Porsche electric vehicles. But yeah, a lot of the kids of these ESG people are driving the $150,000 Range Rovers that aren't hybrids or electrics.
Yeah, and I'm all for the technology. If people want to drive an electric car, fine. Want to have a second car for just around town, that kind of makes sense. But I don't know. We're not seeing as many electric cars in Texas probably as you guys see.
Okay,
Anyway.
so in this environment, then it sounds like oil, at least in the short term, I don't know, 6 months, the next 12 months, depending upon what the Fed decides to do with interest rates and cost of capital, there's not going to be a lot of companies increasing production. Which companies do you think are the low cost producers that can survive kind of a lower oil price in the short term, somewhat lower, or kind of a trading range?
Well, all my companies that get the majority of their revenues from oil sales, they're all very much free cash flow at today's oil at $70 oil. Uh, you know, I mean, and some of these companies which are just amazingly cheap. There's 4 companies in my Sweet 16 that are selling below book value, and they're some of the most profitable companies. I will tell you this: the companies that are trading at the deepest discount to my valuations, they do not pay dividends. So Wall Street will not pay for this. They don't care about production growth. They don't care about proven reserve growth. But at the end of the day, that's what makes these companies extremely high takeover targets. So, Callon Petroleum below is one of the most profitable companies I follow. They had earnings per share of 1963 last year, and the stock is trading for $33. I mean, it has a trailing PE ratio of below 2. Vital Energy reported earnings of $37.67 per share last year, and the stock is trading at like 46 or 7. I mean, that's crazy, but they don't pay dividends. There's some really, really high quality companies, and these companies have really improved their balance sheets. They've used a lot of their free cash flow to pay off debt. They have no near-term debt problems. They are very profitable, cash flow positive, even if oil went to 60, which it's dipped to 67, but it bounced quickly off that every time this year. And here's another thing I want to remind people. I think oil is range bound except for one thing. Sooner or later, some American service people are going to be killed by an Iranian rocket. And there's going to be tremendous pressure on this administration to enforce the sanctions. We have sanctions by law against Iran, but Biden's team won't enforce them. They have not been enforcing those. And Iran is pumping, 2 million barrels a day onto the global market. If we would shut that down, and we can shut it down in one day,
Well,
we could bomb their export ports and shut their exports down tomorrow if we wanted to, but they're
then
not going to do it.
you're absolutely gonna piss off China, because China takes
True.
87% of the monthly oil production for Iran. China takes. So that's the main reason they're not going to upset China at those levels. There's also the other scenario. I agree with you in general about Iran and geopolitical. So, but the other side of this, Dan, is if Iran decides that the other 13% of their monthly oil supply, they just decide we're putting export bans. So if you're siding with the US or Israel or any of their allies, we're going to put export bans on the other 13% of oil. We're only selling it to China. We're only selling
I think they're selling it all to China now. I think China and India import every barrel of their oil, I think.
It was 80. Well, I saw 87% a month ago, but maybe it changed. So a month ago, 100%. It was 87% a month ago, but that was one of the estimates. So I don't know what it is now. But yeah, it's still a large chunk. But I mean, like, Iran could also counter sanctions too. And then the market just says, okay, we need to move the oil price out of the trading range. We need other sources of supply then.
Yeah. And hey, China's laughing all the way to the bank. They're buying that Russian oil at a discount, and we have no way to enforce those. We have no way to enforce those sanctions against Russia. So as long as China and India will take every barrel of that cheap oil they can get, they're going to be able to export everything they want to. So anyway, it's a weird world right now. But I'm just saying, if we start getting servicemen killed by Iranian weapons, there's going to be tremendous pressure on Team Biden to do something about it. It'll just be off the charts then.
Yeah, I think there's a geopolitical spike potential for the oil price. Otherwise, it stays in a trading range until the Fed makes a policy shift.
Yeah, it's true. And the one here's another thing. If they're truly stopping raising interest rates, you're going to see the US dollar come down a little bit. And if the US dollar comes down in value, then oil always goes in the reverse. So that could help because the
Well,
dollar's been again staying very, very strong. So
also, if they cut interest rates enough, then the auto loan prices will
yeah,
fall, and
there you
then
go.
people will rent out more will buy or lease more sport utility vehicles, maybe.
Yeah, I don't know. It's much tighter market than you think, so it's not going to take much to do that. So, and like you said, I think the only thing keeping the price down is this fear of recession. They've been advertising this recession forever. It seems over 2 years. So, I don't think, but it's going to take a major global recession to reduce oil demand.
But then you're going to see supply come offline too if
Yeah.
supply gets. So I
Yeah.
mean, like people are like, okay, if there is a dip in oil prices, I think it wouldn't last very long, maybe a quarter or two at most, similar to like 2020, because
That's
then a
right.
lot of supply would come offline, in my opinion.
Yeah, well, for one thing, our depletion rate is much higher because these shale plays deplete much faster. So unless you're drilling more wells constantly, adding more wells, if they just would cut their drilling in half, you'd have a significant drop in production very quickly. So
Do you think that's going to happen anyway? Because the last couple times we're on, we were talking a lot about drilled but uncompleted wells, and I think the inventory for
yeah,
those
that's
isn't.
gone. Yeah, the duck inventory, the good ducks are all gone now. So we're only pretty much completing the same number of wells we're drilling now. The
So
duck
there's
inventory is back to normal.
for our listeners out there, that's like spare capacity. That's inventory for
Mhm.
shale plays. So like in 2020, there was I think 4,000 drilled uncompleted wells. So they could bring those wells online. What in a couple under 6 weeks, right?
Yeah. They're just their case sitting there, and all they do is have to send out completion crews to complete them. But the ones they completed were the best ones. So the good ducks are gone. There's a lot of what I call dead ducks in the duck inventory. They're going to be plugged eventually. There's always, several thousand drilled but uncompleted wells waiting on a completion crew because you don't drill them and immediately have a completion crew come in. Usually they'll drill maybe 4 or 6 from a pad and then bring the completion crew in after the drilling rig leaves. So there's always an inventory of duck wells.
But this inventory is way lower than say 2020, because
Oh
2020
yeah, for sure.
there was a record amount, right? There was
Oh yeah,
around
it went up.
4,000 and it was tier one acreage, and
No,
that's gone.
yeah. I think it went up to like 7 or 8,000.
Wow.
It really spiked up there for a while because everybody just stopped completing wells because they don't want to complete those high rate wells into a $20 or $30 oil price. They'll just stop. And that's what would happen that's why oil price cannot dip very low for very long because you just stop completing wells.
Do
Anyway.
you think that ExxonMobil and Chevron then are in the best position of the larger companies and based on their acquisitions or low production costs or cost of capital in this type of environment where the oil price in the short term either will go a little bit lower or trading range?
Yeah. See, I think high interest rate environment really benefits them because their cost of capital is way lower. They all have tremendously strong balance sheets and access to a lot of capital. I mean, the bankers would love to loan them money, and they'll loan them money for these deals too. That's why they can get them closed. But there's a lot of good companies now. EOG Resources look really attractive to me at this price. Diamondback, first class. If you're bullish on gas, look at EQT. EQT Corp is the largest gas producer in North America, and if we're right about gas prices going up in a couple of years, that thing's going to go way up from where it's trading now. So there's a lot of good ones out there. Permian Resources looks very good again. I'll tell you that.
Was it Devon or was it the other Oklahoma natural gas infrastructure company that just made a large acquisition of what was a pipeline company?
I don't know. I went Devon because I follow Devon. I don't think them. Devon's it's a nice company. It pays a nice dividend. So that's one to look at. It's in our high
Oh,
yield income portfolio.
it was One Oak.
Yeah. One Oak is a midstream company that merged with another midstream companies. They don't have any upstream production. They're just midstream company. They merged with Magellan, and I love that deal. If you want a safe dividend, you're not going to find much safer than One Oak. It's a first class. I'd rate it AA plus safety rating on that one.
Are they MLP now, or did they just
No.
buy the MLP?
They're C corp. It's a C corp.
Okay, so they bought the MLP
They
assets, but now it's all under a C
yeah
corp. So
yeah
people aren't going to get screwed over on taxes.
no, yeah, it's what happened is Magellan becomes a controlled subsidiary of One Oak. So Magellan is no longer free trading. So you can only buy One Oak, and it is a C corp. And here, yeah, it's a good one. It's a damn good one.
Well, when I was a oil analyst, my day job about 10 years ago, I mean, Magellan's always underperformed. So like on the valuations,
Right.
everyone's like, Magellan's cheap, and it was cheap for 10 years.
Yeah, cheap for 10 years. Yeah, finally get together. But they're a highly respected company. When I was in Tulsa, I looked out my window right at their office in Tulsa. They were one of the most highly respected companies. It's a very old company. I think it's over 100 years old.
Are there any of the Sweet 16 companies you have that you think will be able to grow a lot in this environment, or do you think that they're going to be a lot more cautious than usual, considering interest rates and that energy prices could fall in the short term?
I mean, they got a lot of growth potential. That's why they're in there. I mean, the Sweet 16 is a growth portfolio. Uh, I love Baytex. I just added it to the Sweet 16. It's a Canadian-based company. They merged with one of my top picks. They merged with Ranger Oil, and it doubled their production. And I don't think the market has really figured that one out yet. And it's got like 180,000 barrels a day of production. Yeah, I don't know if you're familiar with Eric Nuttall. He is one of their major shareholders, and he just loves that company. It trades in the U.S. as BTE, pays a little dividend, but it's really, really a big time growth company. Let's see. EOG obviously has got whatever growth they want to make it. EOG has like 8 or 9% annual growth just locked in. And for a company its size, that's tremendous. To be able to continue to grow at that percentage is just incredible. Diamondback is very much of a growth company, pays a very nice dividend. In fact, EOG and Diamondback have both announced that they're going to be paying much higher dividends. I think they're paying out like 70% of their free cash flow in fixed and variable dividends. So those two look really good. Matador Resources, I would also say MTDR. I'd label that way. It's a pure Permian company. So and I also think that it is a takeover target. It's large enough to be attractive to even some of the majors. That one looks really good.
For our listeners who are not familiar with Eric Nuttall, he was a junior analyst, I think, at Sprott. They hired him out of like top scores of business school and accounting. And then he was their top oil and energy analyst. And then I think he ran their oil and energy hedge funds. And then I think he went off and did his own thing. And he runs like one of the largest oil and energy hedge funds in Canada. He's on the business BNN Bloomberg up in Canada a lot. So he's considered one of their top oil and energy experts.
Yeah, and I agree with him on everything. He's really a sharp guy. Yeah, his funds is like $1.5 billion or something now.
Yeah, I met him, I think, up in Toronto, like 2014 or 2016. One of the two times I was flown up to Sprott Inc. headquarters up in Toronto. So I met him when he was like just starting his career.
Really?
I mean, yeah.
He's a really young looking guy too.
Well, I got to meet Eric Sprott in person, 2.5 beers with him. Eric Sprott's for a billionaire. I mean, Eric Sprott's got a really down to earth personality. Really cool guy.
Yeah. A lot of those guys they're nice guys. Anyway.
Well, would you say, as we wrap up here, would you say that on valuation, the Canadian oil and natural gas companies are a lot cheaper relative than to American ones?
Yeah, I don't know, but man, some of these mid cap and small cap Canadian companies, they're trading for less than 2 times cash flow. Baytex looks really good. Let's see where now. It's trading about 3 or 4 times cash flow, but still, that's cheap. I mean, it's
will
really
American
cheap.
ones not buy them? So there's not going to be any mergers across the border then?
Yeah, but actually, Baytex now over half of their revenues comes from Texas. The Ranger Oil is like 60% of their revenues. So it's a Canadian based company, but they got a big office in Houston now. So you could look at it that way. And stuff they got in Canada is good too. So they hosted a luncheon for us the other day and I was very impressed. They have a new CEO and he's a go-getter. And I love to see that kind of enthusiasm. He had a lot of his team at the luncheon that they acquired from Range, and really, really good, solid young team. And those are the kind of ones that can really rock and roll. Ovintiv, that used to be was in Canada. Canada has moved to Denver and changed its name to Ovintiv, and that stock's down to year to date. Man, it really looks good. They reported $14.80 earnings per share last year. Even with prices down a little bit, they're still going to be at about $10.50 earnings per share this year, and it's trading for 3.5 times cash flow. I mean, it's just, some of these are insane.
Well, if you, it's the generalist investor, and a lot of these, the average person isn't aware of this. So a lot of these pension funds, a lot of these institutional investors, these generalist investors, they actually have in their bylaws, some of them, that they can't buy anything that's non-ESG. So they couldn't buy oil, coal, natural gas, uranium. And so some of them are starting to either get look into this or change it. But like the industry has just like, it's decided over the last 5 to 7 years that all internal combustion engine vehicles were going to be phased out by 2030, according to what the Davos people in the World Economic Forum said, which is just ridiculous because we don't have the infrastructure for all that electric vehicles and all that.
Yeah, we couldn't handle it anyway, if they did.
Yeah, and then the International Energy Agency is saying that like fossil fuel demand is peak, gasoline demand. They keep repeating this stuff, but the data says otherwise from emerging markets, like Dan was saying earlier in the interview. So if you remove China, because China hasn't hit the levels that people expected. I mean, Chinese travel is starting to increase with airline fuel, but the vehicle sales are still like going up for small vehicles in a lot of these emerging market countries.
Yeah, they are. And I'll tell you, we went out and bought a new car for my wife about 5 or 6 months ago. She likes Kia. She got a little Kia SUV, and they have 2 very attractive looking electric cars. And so I asked a salesman, how are those? He goes, we have people test drive them. He goes, I haven't sold a single one. He goes, they're test drive, but because they cost $8,000 or $10,000 more than an identical internal combustion car. And so, and you have to put some kind of special charging thing in your garage. You got to pay for that too.
Well, it's a status around here.
Yeah, it's a status symbol. Yeah.
It's a status symbol that you can buy a Tesla, or I've even seen a few of the Porsche sports car electric vehicles that are like over 150,000. I've seen those around here. I've seen a few Rivian. So it's a status symbol thing. I mean, if you're middle class or you're working a low paying job or a decent job, I mean, like the average person, what, an $80,000 electric vehicle and all those other expenses, like you said, it's just too much.
Yeah, well, you look at Ford when they did that Lightning pickup, they're losing $65,000 per pickup. They're totally getting killed. Ford is getting killed on their electric vehicles.
Well, did you see the interviews with the United Auto Workers during the strike? They said the electric vehicles actually, like, that would mean they would be working less and there would be less of them needed. So that actually hurts them too.
Yeah. But I mean, you can see, I say Tesla is like a status symbol. It's like driving a Mercedes or Cadillac or something. Okay. But guys that drive pickups are not going to be able to stop and charge their vehicle for 2 or 3 hours. Okay. That's not a status symbol to them. They need the torque of a diesel, or they need a vehicle they can run in, fill up. They work. These are working people that buy most of the pickups. I'm sorry, they're not going to buy electric vehicles. They're not going to buy electric pickups. I think you'll see a few, but that's it.
Well, construction, contracting, all the dirty manual labor jobs. Yeah, I mean, electric vehicle is not going to be reliable for a lot of those.
I know. I'm not buying one. I'll tell you that.
Well, I see Rivian pickup trucks around me here, but those things are expensive, but it's not, there's nothing in them. So it's like a status symbol thing. They're not putting like their construction or heavy manual labor or dirty job. They're not putting their small business in the back of the pickup truck like a normal pickup truck.
Right. You're exactly right. When I see an electric pickup, these little ones, some of them have, I think Hyundai's got one. They never have anything in them. There's nothing in the back. So I don't know. But I don't see many of them, I'll tell you that. It's
virtue signaling. I mean, the range, you start using the air conditioning, the heat. If you live in a area that's too hot or too cold, or you start plugging in the electronics, you don't get that 300-mile battery range on it either.
No. Especially with the cold. I heard that the other day too. But anyway. All right.
I think this was a great summary of things. So even if there is a lower oil price in the short term or a trading range, I think Dan has given our listeners a lot of interesting ideas for free, but you cover these things extensively. You've been doing an excellent job for many years on this. Please tell my listeners more about the Energy Prospectus Group, the Sweet 16, and your other model portfolios.
Yeah, we're a subscriber service. It's $350 a year to be, but we we do, or I do, extensive research on these companies and follow them, some of them for a year or so before I even recommend them. I will only recommend profitable companies. I believe investing in profitable companies. And so we're in the process of updating all of our profiles on the companies and models. And so we're just basically an independent research firm. The companies themselves don't pay me anything. I mean, they do host some luncheons. I make a little off of that, or they host a webinar for us or something. But other than that, they don't pay me for the research. It's just my independent look. And I did this, for Hess. I had an M&A group. So I know how to value companies pretty easily. We are looking for companies that pay out nice dividends. Our high yield income portfolio right now, I think the average yield is about 8.5%, 9%. Some of them, I just looked at one today, KRP. Their dividend rate is over 12% annual, and it's partially tax deferred, and it's a C corp. It's not an MLP. So we're finding this stuff all over the place, and several of our companies have been taken over in these takeover deals at nice premiums too. So we booked a couple of those big ones this year.
And let me add here that I think oil and energy, other than uranium, which is on fire lately, which I was calling for patrons for a while now, I was calling this uranium rally all year. And I was into Cameco at $9 to $13 a share. But in general, Dan, the valuations on these oil companies, the profitable ones that you mentioned, the valuations are just dirt cheap. And in the S&P 500 for the oil portion of the S&P 500, I think it's below 4% now for the total asset allocation, which is just ridiculous considering how important energy is.
Yeah, even if you average, I looked at a chart the other day, if you said WTI was going to average 70 going forward, they would have, the energy sector upstream companies would have higher free cash flow yield than any other sector. I saw a chart on that the other day. In fact, it was a chart put together by Eric Nuttall that he proved that. He says this free cash flow is unbelievable that these things are generating now.
Oh, send me that one in emails. I want to put that out there.
Yeah, I will. It's in the Surge Energy updated PowerPoint. I'll send it to you.
It's just shocking on the valuation, but I mean, you could say that across a lot of different commodities other than uranium. Uranium's just on fire though lately.
Yeah. And we some of our guys are experts in that field and they discuss it. We have a lot of industry people in our group and we have a chat room, and somebody says, "Oh, what about uranium?" and they just start talking about it like crazy. So if you're interested, just send me an email and tell me you heard it about on Jason's show. Just to energyprospectus@gmail.com. If you just Google Energy Prospectus, you'll find us, but energyprospectus@gmail.com, that'll get to me.
And I'm very bullish long-term. So in the short term, who knows what's going to happen with the Fed and Iran geopolitical stuff, or, short-term recession or depression for the short term. But when the Fed reverses and lowers interest rates again, we might get another boom. And then if auto loans go back down, I think people will start buying new cars again. And it's just, we're not in a high interest rate environment. The auto loans and all that will put temporarily reduced demand for that. But I mean, I'm very, very bullish long term on the non-ESG energy plays. There's just a lack of investment on the supply side for oil, natural gas, liquefied natural gas, uranium, nuclear power. And then these countries, Dan, that are that want liquefied natural gas import facilities, a lot of them have drilling bans. So they don't talk about this publicly. They're like, the press release is, "Oh, we're going to build this many $billion-dollar liquefied natural gas import facility." It's like, yeah, but they have a drilling ban in their country. So where's the supply coming from?
Yeah, well, the U.S. is going to add a significant amount of NGL exporting capacity because of that. That's coming online too. Just like the LNG export, you're going to get NGL, which is propane, butane, just liquefied petroleum gases that are used for cooking. And there's high demand in South America, Africa for that. And we're building more export capacity. So that's a big business all by itself.
Well, I want to thank you for your time, and I hope you have a great Thanksgiving Day and a Thanksgiving weekend. And you are truly a wealth of information for oil and natural gas, over 30 years of experience in the industry and covering these companies and working as a senior executive.
Okay. Thank you for having me.